Good to be with you here this morning. My background has been working in financial reform since the financial crisis, and we've prepared a number of reports on things like the impact of capital ratios in banking, on the impact of structural reform in Europe, on whether there are implicit subsidies in Europe. And very recently, we've just published our financial market liquidity study. It seems everyone's got a study on financial market liquidity at the moment. So we've just published that as well, commissioned by the GFMA and the IIF. So I'll touch on some of the work we've been doing in my introductory remarks. I wish there was an economic model that could completely, take account of all the regulations and all the complexities in the economy. And of course, such a model sadly doesn't exist. But I do think there are economic analyses and evidence that can be helpful in informing this debate. So I'm going to cover two areas. Firstly, the declining marginal benefit of ongoing reforms. And secondly, the economic impact of some unintended consequences. So those two broad areas. I've got a couple of exhibits. I'll come to those in a moment. But first, declining marginal economic benefits. So it's without doubt that there is a huge economic benefit to a more stable financial system. A number of studies were done after the crisis and showed that the reducing the probability and the impact of a future financial crisis was a huge prize, an economic prize. The 2010 BCBS study suggested a 3 percentage point reduction in the probability of a financial crisis, had a 1.89% increase in steady-state GDP. So that's without doubt. But that doesn't mean that we can pursue financial regulation without considering some of the costs, particularly when some of the marginal benefits do decline as we load more and more regulation and more costs in place. One good example is capital ratios. So looking at the losses incurred by banks since the financial crisis, we looked at all the European banks and found that an increase in capital ratios of 4% would have covered the losses of 17 banks. If you then add in another 4 percentage point increase in capital requirements, that covers the loss of another 13 banks. If you then add another 4% capital requirement, that covers the losses of a further 3 banks. So you can see that the benefits of higher and higher capital ratios must at some point start declining and running out in terms of their impact. That's an example of one regulation. I think the same can be true across regulations as declining benefits start to take place when we build more and more reforms. As I said, it's very difficult to analyse all the regulations all at once in an economic framework. So I've taken a slightly different approach for today. What I've done is a sort of top-down approach, looking at the benefit of economic regulation in terms of GDP, but trying to sort of split that out across the different reform areas. I did that through a very short, simple survey of our financial services practice at PwC. A simple questionnaire for looking at the different regulatory areas and how effective they are at reducing the probability and the impact of crises. The results are up here in your handouts and also on the screen here. It's quite striking that when I look across the various reform areas, all of them have some impact and benefit. There's nothing that really sticks out as not being worthwhile. It does suggest that, as we know, a collective of reforms is the requirement. There's no knockout reform that will solve everything. Again, it's probably no surprise to you in the audience that capital and liquidity is very high up on the list as being effective in terms of reducing the probability and impact of crises. And whilst we've got things like consumer regulation on there, there are broader benefits of consumer regulation beyond financial stability, but it still has a benefit. So what I've done is taken those results and then calibrated them to the potential benefit of a much more stable financial system. And that's where it starts to get quite interesting. So on the second slide, here's the results of that calibration. The difficult thing is knowing how successful the overall package of reforms will be. We will never probably avert a financial crisis at some point in the future for some reason. We'd like to think we could. So this is scaled here in terms of a fully preventing all future crises. And then I've used an HM Treasury assumption for how much the overall reforms could be successful. What we see here is a way of looking at the potential benefits of reforms. Again, no surprise that capital requirements have great benefits and outweigh the costs of those reforms. There are some reforms further down that may have smaller benefits, but also smaller economic costs. I've put sort of enhanced supervision, quality supervision in that area. There are also some areas that actually have quite large economic costs. And we did a separate study of structural reform, and that's where the position gets slightly more marginal when we compare economic benefits and economic costs. So I think in this area, what we're saying is we need to be careful about the diminished marginal benefits within reform areas and through additional reforms, and being very, very careful we don't duplicate and overdo the extent of potential benefits. We're now going to touch on two areas of potential unintended consequences. Firstly, in relation to balance sheet deleveraging, and then secondly, in relation to market liquidity. So on deleveraging, many of the economic impact studies in this area, and also the intent, thought that there'd be a repricing of financial services as a consequence of the reforms. What we've seen is there has been deleveraging, particularly in Europe as compared to the US and Asia. And much of that deleveraging has been on the equity side, so the good side of increasing equity through retained earnings and higher capital ratios that way. But we have seen deleveraging across parts of the bank balance sheets, 20% overall in Europe and 40% in other areas of the trading book. And it's that deleveraging that does concern me, because I think there's a bigger economic impact from deleveraging and removal of activity than through simple repricing. I think paying slightly more for financial services is a price worth paying for a more stable system, but deleveraging has a bigger economic cost. We looked at this in our structural reform study, and we found that there's a 27% greater economic impact in a deleveraging scenario compared to a repricing scenario. So I think we do need to look at the degree of deleveraging, particularly in Europe. One related impact is on financial market liquidity. So as I said, we published this report on financial market liquidity recently. One of the linkages between deleveraging has been a reduction in dealer balance sheets and their market-making activities. And the findings of our study are threefold. Firstly, we looked at market liquidity across a whole range of global asset classes. And we do find that the nature of those markets and the way liquidity is provided has changed, and most market participants agree with that. So we do think there has been a reduction in liquidity. We do think there is an empirical linkage between liquidity provision, the market maker's role, particularly in over-the-counter markets, and the cost of finance for companies. That's a link we can establish empirically. But what is interesting in terms of liquidity is when we look at the current impact of a lower liquid environment, we're not seeing much detrimental effect. I think the overarching monetary environment, the economic environment, and state of markets means that when we look at things like the liquidity risk premium and trading costs, we've not yet seen much of a detrimental economic effect. So we've had the benefit of stability without those current detrimental effects. But I think the empirical work suggests that there will be a long-term structural impact here, and that's possibly one of those unintended consequences that doesn't massively duplicate the cost of reforms, but is certainly a significant and non-trivial impact in terms of the cost of banking reforms. So that's two areas, I think, of unintended consequences, deleveraging and market liquidity, that are relevant in this area. So in conclusion, one last note on how to take everything forward. I think there's a need to look at across the piece in terms of cumulative impact. An approach that I would also like to see more of is not a lens of regulation by regulation or institution by institution, but market by market. So how has the collective regulatory set of reforms impacted individual markets? And let's have a look at those markets and see whether they're working, whether it's securitizations market, whether it's corporate credit market. How do we want that market to work? And recalibrating that way could lead to regulatory changes and refinements. But it's a sort of more market-based focus rather than the institutional or stability focus, which is valid but also quite difficult to do.